Good day, good morning, good afternoon, good evening to you, wherever you are in the world. We have an awful lot of people on this global roundtable and more joining by the second. My name's Philip Middleton. I am chair of the OMFIF Digital Monetary Institute, which is having the fascinating challenge at the moment of examining all things digital in the financial services sector, particularly with relation to the official sector, central banking, and so forth. And we have a wonderful panel today to look at the enormous topic of digitization and innovation in financial services from a public sector central banking viewpoint. Lots to talk about, and an extremely distinguished and highly qualified panel as well. And I am going to shut up shortly and let them get on with it and impress you with some very interesting ideas indeed. Before I do that, just some rules. This is a public meeting. It is all on the record. Indeed, it is being recorded and will be available on websites thereafter. I'm afraid you only get to see and hear us, myself and the panelists. If you wish to ask a question, and I hope you do, please will you type it into the question or the chat function. That will then go to one of the OMFIF team and get relayed to me, and I will be able to put it to the panel. We are going to ask each of our panelists to give us a view for about 10 minutes. I may lob in one or two questions just to keep them awake, and then we will pass over to you. The preamble to this is that it's now become a commonplace that the COVID crisis has accelerated the move towards what people are calling digital transformation or digitization. To be defined, it is a vast field, but we're seeing it in everything from retail, where certainly in the UK, high street clothing shops are shutting down and being replaced by online boutiques. We're seeing it in our everyday financial services, where physical cash is being replaced by digital, principally M1 at the moment, but we may get on to my specialist subject, digital M0, CBDC. And strangely enough, certainly in the UK, I don't know if it's the same in Italy, whilst the usage of cash is going down, the store of cash in circulation is going up. And the Bank of England is at a bit of a loss to explain why that is. And then, so the whole ecosystem, the environment which central banks, regulators, public policy makers are dealing with is changing massively and rapidly, and it raises questions about digital identity, digital security, always on, etc., etc. And within central banks and regulators, digitization also raises a range of possibilities, challenges, about who I regulate, how I regulate, with what do I regulate, and with what I do. In one of my other jobs, I am a financial services regulator, and we're starting to look at the applications of AI to processing firm returns. So in the sense, if you can get a computer to read it rather than the human being, you might be a bit more accurate as a supervisor. So that's just to set a very, very wide stage and to encourage our very brilliant panel to explore all sorts of nooks and crannies. I am delighted to welcome as our first speaker Signora Alessandra Perrazzelli, who is the Deputy Governor of the Banca d'Italia, which is, of course, probably a more secure post these days than Prime Minister of Italy. So, so without any more ado, Alessandra, over to you to get us started.
Great. Well, thank you, Philip. You know, indeed, you know, digital payments have ramped up, you know, during this this pandemic, and this is true around the world. The growth has, you know, has been different across the different markets, and also different in the different stages of this pandemic. You know, novel data sources can help us and follow these trends. In Italy, we did exploit timely indicators of payments habit in order to, and cash also usage. You were referring to that, relying on the high frequency data that we collect at the bank through a number of both settlement and processing systems. Now, the you know, the emergency and the government measures that have been taken in order to contain the diffusion of this infection has, you know, incredibly intensified electronic payments, both at the point of sale with respect to cash withdrawals, and you know, and this has been, you know, mainly through contactless cards and e-commerce options. We also observe an increasing use of online banking, especially for online credit transfer in substitution of the traditional payment instruments, you know, such as cash, checks. These are effects that seems to be persistent and they're still going on. So the pandemic could really represent a structural break in the habit of a consumer in relation to payment, and really much a game changer in the process of the substitution of the various means of payment in the society. So, you know, in particular, our evidence suggests that the policies that are aimed at accelerating the digital transformation of the economy and the innovation in payments habit has the potential to make the economy more resilient to adverse shocks and more competitive as well in terms of consumer and business opportunities. So, for instance, in the first wave of contagion and the period of lockdown in 2020, the one that started about a year ago, it's been a year for now here, cash withdrawals dropped minus 20%, while electronic payments at the point of sales reduced only by 4% in 2019. So these trends have been pretty much similar during the second wave of infection, with a new significant upward shift of e-commerce payments and contactless transactions. So, and you know, if we look at cash demand, you know, as we said above, we observe a shift from cash to cashless payments during the emergency, but we also look at the effect of the pandemic on cash balances. We see there is a rising trend in the banknote in circulation and an increase in the average transaction value of ATM cash withdrawals. And these figures relate to the impairment in the cash cycle during the lockdown and the restrictions provision. Especially if we look at the collapse of lodgements to the central bank, but also, you know, in relation to the potential role that is played by a precautionary motive of cash demand in a period where there is, of course, a worsening of the economic outlook. So from a policy-making point of view, CBDC can combine both these needs. Now, of course, you know, if we then check on, you know, this disruption, you know, there is a lot of different things that we can do, and we can decide to have an approach that you know, is more towards managing risk or towards innovation. But I think that we will talk about this maybe later on.
Thank you. Yes, throwing us in. Just one question to you, which is, We see CBDC accelerating apace in many parts of the world. Chinese already have People's Bank of China has a massive beta test going on. We see it being launched in small islands. Bermuda, for example, is already going. The Eurozone seems to be taking its time, and various participants within the Eurozone seem to be wanting to move a bit faster. What's the Banca d'Italia's view of the prospects for a digital euro?
Well, we invented TIPS. Banca d'Italia is the owner of TIPS, and TIPS now is, one of the technologies that have been used, that are used right now in the various process of experimenting right now that the ECB has started with regard to the development of digital euro. So we are very much involved in the technical aspects of it. We think that we shouldn't lose our time. I think there should be this process of trying, the different technologies in order to choose the best possible one to implement a digital Europe should be going forward without hesitation. So we're very much at the core of the experimenting the technical solutions. We think that there is convergence among the countries, the main countries of the Eurozone, and we are in favor of making fast and steady steps towards it.
Can I ask, maybe slightly unfairly, I mean, the Eurozone encompasses a vast variety of cultures, and in some of which, for example, cash, and I'm thinking in particular of Germany, Bargeld, is far more significant than electronic payments always has been. They say in German, bar is wahr. Cash is the only thing that's that is real. How is the ECB or how are national banks going to convince citizens that the digital fiat currency is a good idea?
Well, I don't want to say that COVID is an opportunity because it's causing too many losses and too much pain to all of us. But there is one thing, and is pretty much in the numbers that I was mentioning before and the trends that I was mentioning before. And I think that the citizens are getting used to the idea of using electronic payments, e-commerce, and in general, cards or cardless even payments right now, much more than in the past. I think this pandemic has been an accelerating factor. And I think this is pretty much across different areas of business and across generations. I think that also those generations that have been, culturally, historically relying on cash are becoming a lot more familiar with the idea of accessing the internet to make their, their online shopping, and they're getting more used to the idea of using cards in order to make payments, at the point of sale. So in a way, I think that this pandemic and the fact that the new normality is going to be very different from the normality that we had before. It's going to push citizens in becoming a lot more open towards the use of digital money. And if there is one good thing about this pandemic, maybe this is it.
Well, that's interesting. I'm fascinated to see that you envisage a fundamental shift to something that is new rather than a bounce back to the old normal, and I mean, that creates some fascinating opportunities, and I would think as well challenges for policymakers. So it's fortunate that our next speaker is a policymaker, Peter Kerstens, who has been at the core of EU policymaking in e-commerce, financial services, and much else for the best part of a quarter of a century, and clearly has played a major role in some major transformations. So a shift to a new normal should be nothing abnormal for him at all. So I pass the baton to you, Peter, to give us your view of where we are.
Well, thank you very much, Philip, and thank you for those kind words. I live indeed already for a quarter of a century in the European Commission, and for me personally, all change is good. Life is too short to always stick with the same thing, so we have to embrace change. And at the European Commission, of course, we look at the financial market for the entire European Union with all its diversities. And what we see really with digital transformation or technological transformation in the financial sector is that it is changing the face or maybe the interface of finance. And it is not just one technology or one sector. It's not just in payments, or it is not just the use of blockchain, but it is the confluence of all of these technologies that allow companies to rethink and re-engineer the front office, the mid office, and the back office of the financial services value chain, be it in payments where it is most developed so far, but also in lending, in investment, in trading, in insurance. Pretty much any vertical of finance is being digitalized. And what we see, and to come back to COVID-19, that has acted as an accelerator. These trends, what we see currently was expected already, but the pandemic has really moved this much more forward. So this technology is in many respects changing the face or the interface of finance, but it's not changing finance as such. What I mean with that is that online lending is still lending. Digital payments are still payments. Contracting insurance online or settling your claim on your smartphone is still insurance. So while this technology may change the face of finance, it doesn't change the heart and soul of finance. The risks, the market integrity risks, investor protection risks, financial stability risks in digital finance are just as present as they are in traditional finance. Some risks may be a bit bigger, some may be a bit lower, some may manifest themselves differently, but they're there. And if you look at financial services policy and regulation, this is of course very much geared towards the risks. It's also geared towards embracing the opportunities, and we try to do that. But the fact of the matter is that if you look at financial services policy and financial services regulation, even those regulations that are enabling and supportive, that try to embrace the opportunities that are present in finance, if you scratch a bit at the surface, you see that actually the main provisions are always about the risk. In Europe, of course, we always have then also the cross-border dimension, the passporting and facilitating cross-border financial service provision, but we're focusing on the risks. And the European Commission is trying to balance these two things out, seizing the opportunities of technology for better and more convenient services, for lowering the risks if at all possible, for creating new business opportunities, for alternative providers. Not that we have any shortage of banks or insurance companies in Europe, we have thousands of them, but the more the merrier. We think that having new kids on the block, new players that light a little fire under the incumbents is always good for the market dynamics, and it's always good for the consumers. And that is ultimately whom we're after. So our policy, and we've set this out in a digital finance strategy, has a number of legs, a number of focus areas. The first is to exploit the opportunities of a single market. Much of digital finance is transaction-based and transaction-focused. They require scale because you want to recover the investment, and the margins, especially in a digital environment, the margins often can be much smaller because the willingness of the market to pay for the services is lower online than it is offline, and this is quite remarkable. So you need to have scale, and while some of our member states have scale within their national borders, quite a few do not really have the scale to sustain a vibrant digital marketplace. But what is without doubt and without dispute is that the EU as a whole does have the scale. It has more consumers than the United States, for example. Of course, it is nowhere as many as China or India, but if we pull together, we have a large market that provides the scale necessary for a vibrant digital financial marketplace. The second strand of our policy is that we have to make sure that while digitalization doesn't change the heart and soul of finance, it does change finance a bit, and we have to make sure that our rules are adapted to these new realities and to the new technologies. Because rules, while we want them to be technology neutral, and that's always an aspiration, again, the fact of the matter is that any legislation and any rules are always written with a certain technology or a certain business model in mind. Rules and regulations tend to reflect the state of the art of the technology at the moment the rules are adopted. The rules are fairly stale, they remain more or less stable, and the technology evolves. And gradually, you'll see that there are new business models, new activities that do not fit the rules or that fit badly. And then the question is, what do you do? Do you say, well, look, these activities just have to comply with the rules and we have to forgo the innovation? Or you say, no, the innovation actually is quite promising, so we should make sure that our rules evolve with the technological possibilities so that this activity can develop. A third leg of our strategy is data policies, data spaces. I often say that finance used to be about money. I'm Dutch, and in the very, very old days, finance was even about tulip bulbs. So that was a very short time. When people think about finance, they think about money. But if you analyze that truly in today's finance really is much more about data and technology than it is about money. Of course, it is still, the money part is still very important, but the data part and the technology part are becoming increasingly important, if not more important, in some segments. And therefore, financial services policy must be data policy as well. And this has to do with, on the one hand, how the market reports data and transactions, and can this be done in a standardized, automated way? But it's also about access to the data. Who can have access? And how can you facilitate access to market data, trading data, so that people can take better investment decisions or can develop businesses based on this data? And the third is, and it's very important, is what we call the sharing of data or open finance. The fact that we have this already in the payments area, in the Payment Services Directive, where banks and payment companies must share account data with alternative providers if the consumer so wishes. And we are looking into, and of course we're looking into, and we have the ambition to expand this approach to other financial verticals. Now, we haven't taken the decision as to which verticals this would apply to, but we're reviewing all of them. For example, should there be data sharing on investment accounts, on savings accounts, on insurance accounts? So that's the question which we ask ourselves. And if we do sharing of that data, or if we force or require the sharing in a secure setting, in an automated setting, what are the pros and cons of such data sharing? Fourth element of our strategy is identity, digital identity in particular. If we want to have an EU-wide digital financial marketplace, it has to be possible to onboard your customers remotely. And that's still very difficult. In our ideal world sitting in Brussels, we think that a consumer in the south of Portugal or the south of Italy should just as easily be able to deal with a bank in the south of Portugal or the south of Italy as with a bank in the north of Finland. In the offline world, that's very hard. Online, location doesn't really matter. And so it would be possible for an Italian consumer or a Finnish consumer, for that matter, to have a bank from the other country. But this requires that these banks can onboard these customers. And for that, customers need to have an identity, a digital identity, which is recognized. And we don't have that yet. Digital identity is also extremely important for authentication of transactions and for security. So these are four bigger areas. In our financial strategy, we've also proposed two legal packages currently. One is on crypto assets, in particular crypto assets that are not financial instruments. So if they are financial instruments, they are regulated by existing financial services legislation. But we see a lot of crypto asset activity that, while from a functional approach, you say, well, this is the same as lending, or this is the same as securities. From a legal perspective, they are not financial instruments. They fall outside European or national definitions of financial instruments. And so it's a bit of the Wild West there. Anything goes. When these markets go up, people don't really complain very much, and we've seen the markets for Bitcoin and a lot of alternative coins going up in recent months. So people are all quite happy and they don't complain. But we see a lot of very questionable practices taking place and huge risks building up in that sector as well. And our proposal for markets in crypto assets is trying to put some order in it. Not by regulating out activities, by banning activities, but by regulating them in, and by having standards for issuers of crypto assets, which are very important, so that there's transparency, that people know what it is they are buying, but also standards for crypto asset service providers, people that provide brokerage services, trading venue services, exchange services for crypto assets, so that we have some more market integrity in that area and a bit less for example, market manipulation, which seems to be an important element also in the very volatile price movements we see in that market. Final element of our package is operational resilience or digital operational resilience. Again, if you look at financial services legislation in the EU, but also beyond, it deals mainly with economic and financial risk, and that's normal, that's acceptable. But because of the role of technology in finance, and because of the fact that finance is as much about data and technology than it is about money, the operational risks, the digital operational risks, are becoming much more outspoken these days. And we are adapting the European single rule book, as we call it, which is a bit patchy when it comes to operational risk and qualitative rules of operational risks. We're completing that with a regulation which we call Digital Operational Resilience Act, and that will put high common standards for ICT governance and security standards across all financial sectors in the EU. It will have streamlined reporting requirements for incidents, but it will also very importantly look at third-party risks, in particular ICT risks that the financial services sector runs that come from third parties that are not regulated as financial entities, technology firms in particular, that are extremely important in the financial services value chain, but that fall outside of the regulatory perimeter and outside the purview of market conduct and prudential supervisors. So we want to bring that in a bit, at least the most important ones. And then finally, just like we have economic stress tests to see whether our banks or large financial entities can support or can withstand economic and financial downturns, we think it is important that financial entities also test their operational resilience by subjecting themselves to, be it controlled and friendly attacks, by requiring companies, and in particular the larger ones and the more sophisticated ones, to subject their systems to what we call hostile review, to see how good they would withstand if someone makes a dedicated effort to try to break into their system. And that with that, we really would be putting what we call technology stress tests on our financial operators. That, I think, is in a nutshell, is how we see technological innovation and its regulation. For us, it is mainly an opportunity, and we want to embrace that opportunity by having a supportive, proportional regulatory framework around that. Thank you.
Well, thank you, Peter. That's an extremely comprehensive nutshell. You've covered a tremendous amount of ground there, and absolutely fascinating. And incidentally, also saved us from needing to read every word of the EU financial strategy, and given us a briefing on crypto tulips as well. You've provoked a whole range of questions. One's come through from Alistair Ryan of the Bank of America, who, if I may paraphrase his question, is saying that high returns in financial services quite often come out of regulatory arbitrage. For example, if you look at the payments business as an example there, if you look in brokerage as another example. And you made this very important point that rules and regulations are frequently based on the existing technology rather than the emerging technologies. How do the authorities ensure that we have a level playing field that maximizes opportunity for both incumbents and new players, whilst at the same time preserving financial stability and indeed preserving fair competition?
Yeah. That's a good question, and a level playing field is, we talk a lot about it, but it's often more aspirational than real. A level playing field is also a notion which seems to come from football or soccer or basket. But who says that the financial game is being played on a flat pitch? Maybe financial services are more like the Tour de France, where you have a mountainous terrain, or maybe it is more like golf, where the players can have a handicap, so that certain players have a better handicap or a worse handicap, so that they can compete with each other. So the idea that the notion I try to say is that the circumstances, including the regulatory circumstances, can suit some players better than others, or some companies are better at exploiting the market and regulatory realities than others. Now, I know that some people say, well, it's unfair. Banks have all kinds of requirements in terms of capital and solvency, and these alternative payment providers and these technology companies, they are not subject to this financial regulation, so they have a free pass and they can compete unfairly. And that is indeed, there is indeed a possibility of that. We try to contain that risk of unfair treatment, but at the same time, we must not ignore that there are advantages to being a bank. A bank can extend credit, so it can create money, commercial bank money, which these payment companies cannot. So for, I'm generalizing, but sort of for every 100 euros a bank puts into circulation, it by and large only needs to have 8 euros in its vaults, whereas these payment companies can't do that. So there are also advantages and opportunities and competitive advantages that banks have that these alternative providers don't have. Whether all of these elements taken together create really a level playing field or more ambiguous areas, I think that will depends on everyone's individual perspective, or also on a flat field. If we come back to the Tour de France, it may depend on where the wind is coming from. The terrain may be very flat, but if you're playing against the wind, you still have a disadvantage.
Yes, although if the regulator decides that certain categories in the peloton can have engines on their bicycles, you're also going to be at a disadvantage. And worth observing that somewhere around 40% of the current profitability of European banks comes from running payment systems. And if a combination of central bank driven fiat currency, digital fiat currency, and private money, digital private money, are regulated and permitted, you could end up potentially destroying the profitability of an entire industry. And so I think when you talk about the changes that technology is bringing around, I think it's an interesting question for regulators. Are you prepared to upend the very stability that is part of your current mandate in pursuit of the future? Do you have a view on that, Alessandra?
It's by the way, level playing field comes from the rugby pitch. So it's the rugby world that invented it. Now, this is a tough question, Philip. It's really like in between, two different forces. On one side, trying to apply these rules that have been made for an analogic world to a digital world. And that's, it is a stretch that doesn't work most of the times. And then on the other side, how do we measure risks coming from a more open, a more, regulation that goes towards innovation and does benefit also the growth of new industry, the growth of new technical solutions. So that's exactly where we are as regulators. And of course, the idea of a sandbox, we're starting to use one here in Italy soon. We put it, together with the relevant ministries, and now we are in the starting phase. We have created as Bank of Italy a hub in Milan that is working together with the industry, with academia and research centers in order to provide that safe environment that can make us understand, first of all, us regulators, how do we approach all this? So I think we are pretty much we are in a sandbox ourselves, in a way. We are experimenting ourselves which way to go. My mantra, in Italy, I look after banking supervision. I'm a member of the supervisory board of the ECB, and I look after technology applied to this industry. My mantra is for big banks, to become FinTech and to do it quickly and to do it steadily and to, jump to state-of-the-art technology in order to be ready for that level playing field, which is never level. It's always difficult playing field, and be able to compete with the big tech, and also to compete with a different consumer sense in terms of how do we approach finance. The started of DM, formerly Libra, the new technology applied to money and the digital money are going to be very much rooted in the habits that people today have of using social media in order to have access to everything which is consumer and online shopping. So we need to be ready for that. It's very unlevel. I think it's going to be like a carousel. I don't think it's going to be easy for us regulators how to approach this. I'm for step by step. I'm from Sandbox. I am on for really working together with the industry in order to understand how we can better minimize risk and optimize innovation in the making.
Thank you. I gave you a difficult question because that's why we're here, and you answered it wonderfully. And you also teed us up wonderfully for our next speaker, the most aptly named man in finance, Dr. Stefan Profit, from the Deputy Director General for Economic Policy in the German Federal Ministry of Economic Affairs and Energy, who is going to talk to us about innovation, sandboxes and much else from the nation that gave us Vorsprung durch Technik.
Well, thank you very much, Philip. Thanks for inviting me to this great panel. It has been really thrilling to actually hear about all these innovations in financial services. And actually, I think financial sector is a front runner in digitalization. But since I'm not from the finance ministry, but from the economics ministry, I will take the opportunity to present you or tell you about our sandbox initiative that we have and have created in this ministry, which is actually not concentrated on one sector, but is of cross-sectional perspective. So to keep in sports analogy, it's about cycling, football, rugby, and tennis, and everything else. So we go all across sectors. But what is common to all the sectors and all the sports is about pace. And Alessandra and Peter have mentioned that the pace problem, that as the OECD puts it in digital technology, is that actually there has been a ever greater disconnect between technology and regulation. And actually this disconnect is widening and is particularly widening through the COVID crisis, I think. So there's an urgent need from our view already before the COVID crisis. The crisis has made it even more obvious for agile, flexible, evidence-based, data-driven approaches to regulation. And the sandbox approach that we are taking, and you can see the nice backdrop we have behind me, where we advertise it, is one approach to overcome this disconnect. And the main fields we're working in is not the financial sector, but it's more in the transport sector, the logistics sector, aviation, health and energy sector. And the goal that we have is actually to use these sandboxes to overcome barriers to innovation. We try to allow enterprises to test new products and services in the real world, even though they are not allowed to under the current general regulation and legal frameworks. We actually advertise the use of experimentation clauses and give advice in designing experimentation clauses, which is crucial, I think. And the second part is actually that we take from our initiative is regulatory learning. Because I think in innovation, you have to look at the whole innovation cycle, which is innovation, but then experimentation, but also evaluation and experimental learning. And also the issue that has been mentioned by Peter, a whole bunch of consumer policy issues come into the field as well that have to be solved. And we also try to address these in our sandbox approach. So we actually, what we did is, we take two approaches. We try to improve the legal conditions in Germany in sectors in cooperation with the respective ministries, and also we support concrete projects. But I want to focus on the regulation side today and give you some examples. For example, we have created guidelines for innovation-friendly and compliant experimentation clauses in legal acts. and we try to convince and work together with other ministries to implement these experimentation clauses. For example, we're just working on a legal act on testing highly automotive driving, for example, on also for new business models in public transport. We also, and that's closer to financial markets, work with the Justice Ministry on a legal framework to test digital execution of real estate contracts. So the whole process of buying and selling real estate and all the registry issues, the notary work is going to be in one digital process, and this has a very, very nice side effect also to the issue of macroprudential surveillance, because that will provide official data which is urgently needed by the central banks to monitor real estate pricing for macroprudential surveillance. So these are just two examples where we actually try to work on. There are many others. One field, and also closer to financial services, is that we also, during the German presidency until December, we promoted the use of sandboxes at the European level as well. And actually in November, we were successful in initiating a council conclusion among the 27 European member states on the definition and the promotion of regulatory sandboxes and experimentation clauses. And these also are very much related to financial sector initiatives, and Peter has mentioned some of those. I would just repeat and shortly mention some of them. For example, the European Commission has proposed a comprehensive package for a new regulatory framework on blockchains. There's a legislative proposal for crypto assets, as well as a legal framework for sandboxes using blockchains and in the trading and post-trading of securities. And the second that Peter has mentioned, that has also been initiated through the European Blockchain Partnership, where the Commission is looking into sandboxes or for special use cases for data portability, data spaces that Peter talked about, smart contracts, and also digital identities, which is a very important issue, I think. So all these issues are underway, and we're very happy that also the sandbox approach, not only in financial services but also in other sectors, has already also been accepted at the European level and will progress there. For the blockchain technologies, which is very much related to financial services, we're also working on a national blockchain strategy that has been passed last year, and we work together with the colleagues from the finance ministry to introduce digital securities there. Well, even though, I mean, regulatory sandboxes, I think, originated, and I think it was an idea basically in the UK, where it comes from the financial sector. I think it has become very popular and very useful all across the sectors in the real economy, it's very important to bring digital business models to the market much faster. So the whole issue is about scope and scale, and that's what we are working on in the Economics Ministry. And I'd like to thank you very much for your attention, and looking very much forward to your questions. Thanks.
Well, thank you, Stefan. That's quite exciting. I think there are a couple of fascinating points amidst all this, apart from the fact that we're all soon going to be off with our buckets and spades. Even if we can't go to the beach, we can go into our sandbox and play with innovation. But two things. One, just hearing from the Banca d'Italia, hearing from Germany, hearing from the EU, it's very obvious that interoperability between EU member states and indeed the Eurozone and national cross-border compliance is going to be an absolutely major challenge going forward. And I already hear signs that different countries may want to do things a little bit differently because for all kinds of reasons. The second is, and something that's become, is that regulation is going to be absolutely key to this. Regulation can either give us an explosion in innovation, or it can completely put the brakes on. And as a byproduct, there is going to be a massive growth in the civil legal sector around this. You know, just come down to something completely basic, like is a crypto contract a contract? What is digital money? Is it money? Is it a promise to pay? Is it a contract? Etc. etc. In the meantime, may I move to our ultimate speaker, who's Dr. Co-Pierre Georg from the Algorand Foundation, leading digital economy firm, professor at the University of Cape Town, advisor to the South African Reserve Bank, also having studied at the Goethe University, member of the Volkswagen, so a multinational citizen and expert, and leaving it to him to round us up and launch us to the next phase. So Co-Pierre, over to you.
Thanks so much, Philip. I want to use my comments just to also reply to a few things that the other panelists said, just to get a bit more of a discussion going. And I want to focus them around two big changes that are happening in the financial industry today, both of which are accelerated by COVID and by the increased digitalization. The first is that there was a recent working paper by colleagues at the ECB around an unbundling of financial services. I think this is a longer term ongoing trend, that what used to be within the same house, under the same roof, is slowly breaking into different specialized services. The underwriting of loans, the payments, everything that is part of the bank offering can now be done by specialized small firms, very often at lower prices, better efficiency, more consumer oriented. Depending on the country, South Africa is a very young country. I think the average South African is something like 27 or so, numbers of which the Germans and the Italians can dream of only, I think. So feeding this next generation of consumers and of customers requires a slightly different take than what many banks can offer. So we see this unbundling of financial services. At the same time, we do see a move of big tech companies into finance. And to me, this is the biggest threat to the stability of the financial system, far more than anything small crypto startups can do. And the big question that comes from this is, how should regulators, how should central banks react to that? One of the reasons why I believe a CBDC is a key part of future financial infrastructure is because it can provide a level playing field, not between big tech companies and small startups, but so that the banks are on a level playing field, because they are at a massive disadvantage at the moment. A lot of the data that is necessary to provide cheaper, better, more efficient services sits with big tech companies already, because we have failed to enclose the data, and we've just accepted that Facebook, Twitter, Google have collected vast troves of user data that they can use and are using to offer financial services already. So the question is, for me, how can we make sure banks will be able to compete with these entrants over the next decade? One disadvantage that banks have at the moment is this lack of data, and I think this is accelerated by the fact that banks do not have a platform on which they can easily compete with big tech companies when it comes to activities that collect data, including credit provision, loan underwriting, and including payment services. So in a way, a central bank digital currency is infrastructure that will ensure a level playing field to make sure that banks are able to compete, which in particular in Europe with the big bank focus is absolutely crucial. So out of the work that Algorand has done around central bank digital currencies, I just want to share very few thoughts on key components of such future financial infrastructure. And there are five key components that I've jotted down. One actually fits exactly with what you just said around the interoperability. So we need to ensure that CBDCs are interoperable with existing forms of money as well as with one another. This is challenging because different blockchains are not natively interoperable. It requires technical effort to do that. They often come at different speeds. Bitcoin, Ethereum, and whatever is built on them tends to be much slower than the next generation blockchains, which are built on proof of stake rather than proof of work. Making sure that different types of players can interact with one another, not just the banks with each other, but also banks with small startups who specialize. South Africa, we have a large immigrant population, including me, where I think 1/3 of all people in Zimbabwe live outside of Zimbabwe, many of them in South Africa. The natural consequence is that we have a large remittance industry in the country. So including these small remittance players into the financial service, into the payment services that are offered by banks has benefits for the banks as well, because they can reach consumer segments that they simply cannot reach at the moment. So it's key to have interoperability. The most important of these components, though, is trust. Whatever financial instrument we create needs to have the same trust features that cash has, which is underwritten by the central bank. So we need to make sure that a CBDC that is created has immediate settlement finality, because if you can trust that your transaction has actually been concluded, can you avoid issues that come from sort of counterparty risk, and only then you can really reap the benefits of tokenization. The other one is scalability. It's a problem that blockchains have not solved for a long time, but which is being solved now, and there are highly scalable blockchains out there that will be able to support transactions of an economy with 200 million people. But even if you just assume 3 transactions per day or 2 transactions per day per citizen, which during Christmas is a lower bound, the requirements on the transactions per second that you have are just very high, which is why there's an ongoing debate between a decentralized and a centralized system. And I'll come back to that just in my last remark in this debate, and which is why the Chinese have chosen to use a very centralized approach. Their system has nothing to do with an open blockchain. It's a very centralized system. Otherwise, they can't handle the transactions on Singles Day, which is the largest shopping holiday in China. So scalability, key issue, can be solved by modern blockchains. Third one, which is a tough one, is privacy. We've spoken about this in the context, and Peter Kerstens mentioned this in the context of data. Finance is about data these days. That is true. The ability to control data boils down to your right to privacy, which is a human right, which we actually struggle based on existing financial infrastructure, because all the data we put in big databases is eventually controlled by whoever runs the database. Blockchains are one of the few approaches where this is not the case, where the data is controlled by the creator of the data rather than the operator of the infrastructure. So maintaining privacy and control and ownership of data will be key in facilitating many financial use cases. Last one is inclusivity. In South Africa, there's roughly 50% of the population who do not have smartphones. And if you think this is because we are Africa, it's not true. In many European countries, large parts of the population do not have smartphones because they feel more comfortable with feature phones, which have normal buttons, and they just want to make a phone call. They don't want apps. And if you take into account how many people use more than 1 or 2 apps on their phone, even in Europe, the numbers of smartphone users will be well below a 2/3 threshold. So we need to make sure that whatever technology we provide is inclusive. It enables people with intermittent connectivity. If you go through the Schwarzwald region in Germany, there are areas where your connectivity is very intermittent. How can you make sure that in these regions you can have transactions? It requires you to find solutions for offline transactions. So we've spent a lot of time in coming up with creative ways that reduces the need for both parties to be online at the same time. All of these feed into this need for future infrastructure, but it can't take away the discussion that policymakers need to have. And that's something that I want to pose to the panel. And that's a discussion of, do you want to create an open system with open standards, open platforms, or do you want to create a walled garden? You want to create the next internet or the next Facebook? And there's advantages and disadvantages to both. So it's an open question. But what we've done with payments in the past is we have created walled gardens. Payments in Europe are not expensive because Target 2 or TIPS is expensive. They are fantastic pieces of infrastructure that just work. They are expensive because of correspondent banking, because we've decided back in the day to have a closed payment system with only regulated entities access to it, which means we have created a walled garden, and the cost that comes from it is non-negligible. And we are at a crossroads now where we have to take the same decision. And I think it's worthwhile to take that step back and think about what is the best way forward, open systems or this closed walled garden. And it's a key decision that I have an opinion, Algorand has an opinion on this, but it's something that I'd be keen to learn more from the panel. And it's not so much about a level playing field. It's about who has access to that playing field.
Thank you very much indeed. That's not only comprehensive and insightful, but also brings up a lot of stuff that we hadn't had before. We are getting close to our allotted time, although bear in mind that on level rugby playing fields, if you turn up as the All Blacks, you have a bit of an advantage. And that's always going to be the case, I think, just as if you're Germany and turn up on a football pitch, as the unless you're Italy or Holland, certainly not England. Anyway, we have a whole load of questions. We're coming to the end of our time, so I'm going to try and combine a few just to pose to each member of the panel some quick thoughts before we close. So I have a follow-up question from Alistair Ryan at Bank of America, question from Michael Altenberg at MAF. I have a question indeed from the Bank of Italy, from your colleague Alessandra Maurizio Georg, would like to know. And so you boiling these down, I also have some boiling these down as much as I can to just pick up on Co-Pierre's setting of the scene of basically we are at a crossroads. Combination of the advances of technology, COVID, a lot of the other things we've discussed, places at a crossroads. Policymakers, regulators are going to be fundamental in deciding, in Co-Pierre's words, whether we go into a closed, hermetic, protective system, or whether with predictability, or whether we head into a brave new world with a lot of potential volatility and unpredictability. Two or three questions coming out of this then. One, does this move permit us finally to get the real integration of balance sheets within the euro area that gives us a single European banking system, or do we continue with a set of essentially national banking systems with national characteristics? So do we have the courage to smash the whole thing up and really profit? What is the balance here between the state and the rights of the individual citizen? Crude example, if Banca d'Italia tells me you must do everything digitally now, Signor Middleton, does that mean I can no longer use euro notes in the tobacconist or the pharmacy or on the metro? So could I throw those two in? Are we seeing the closed garden? Are we seeing a brave new world? What is the balance between the state, as represented perhaps by the central bank or the Ministry of Economics, and the individual? Alessandra, you kicked us off. Can I start you with the final response, please?
Of course, very, very briefly. This is an opportunity to do two things: to avoid regulatory arbitrage, and that means that we need to put together, make the banking union work in the euro area, come to the end with the capital union as well. And second issue, decide which principle we want to apply when we look at measuring risks and innovation. So far, we have been saying same risks, same rules. And so that should, mean that for those newcomers, that they come to the financial industry, they'll have to somehow be measured with the same attitude that we had in order to promote stability in the markets, to promote financial stability in the union. So I would say it's a very narrow, it's a very narrow, passage that we have to get. But this is it, it's not going to be easy, but I think that there is a lot of need for, to converge at European level if we want to make Europe a zone where innovation is promoted and also risks are measured in an even way. Access and measuring risks. That's what I think we need to implement here.
Thank you. Peter, you and the ECB together are going to have a big role in all of this. Where do you see the balance?
Well, to come back to the crossroads, crossroads are places of friction, and you need to have traffic lights, and people need to stop and so on. I think, or I hope, that it's much more of a roundabout where the integration of the various elements is much more fluid. You still need to have rules of the road as to how a roundabout works, but it tends to work much more fluidly. Now, specifically, I think that digitalization presents enormous opportunities, but if companies, banks, and also member states are going to hold on to walled gardens, national systems, and are trying to slow down integration and banking union, capital markets union, I think, and actually also I fear that those companies, those banks, those financial institutions that currently benefit from the protections that are the result of these closed gardens or these walled gardens will end up becoming obsolete, because other companies that will really exploit the advantages of the technology will run them over, and consumers will demand and will expect the services to be delivered digitally to them, and they don't really care about banking union. For them, it is just a loan, it is just a payment, it is just an investment, and whomever can provide this in the most efficient, convenient, and cost-effective way is going to prevail.
That's an interesting observation for a senior EU official. Stefan, I pass the baton to you.
Well, the balance that you ask about, I mean, whether citizens are actually will use digital payment channels or cash. I think it has been a very sensitive issue in Germany, and I really think, I mean, the consumer will decide, and COVID, I think, has fundamentally changed the opinion and the behavior of people towards digital payment. And I think that there's not a strong role of the state. What is important, as Alessandra said, is to get the banking union to work in Europe, also the capital market union. And actually what Pierre said about the disadvantage of banks not being able to pool the data, I mean, we have to enable the banking system to use the data efficiently that they actually have for a long time. I think they traditionally have much better data than e-commerce companies that are fairly newly working with the data. But I mean, banking data is very good and very wasteful, available. So it just has to be used efficiently. I think, and the banking union and the framework is important to be able to do that. Maybe one point about, Philip, about your remark on interoperability. I think you're right. I think in the financial sector, like common rules and like if you have like the common risks and you should have common rules is right. But in the real economy, I think also competition of regulation is an important issue. So if you have a drone regulation in the Netherlands, for example, or in the health sector, digitalization of the health sector, and some countries are setting benchmarks, this has a very strong effect on other countries in the single market to follow up with their regulation. So I think we should also not only look at what we can harmonize in Europe, we should also use the power of competition, of regulation, to facilitate innovation.
Thank you. I give the final word to Co-Pierre. Are you optimistic or pessimistic about, are we going into a walled garden or into vibrant sunlit uplands?
I'm not sure. I think Europe is too late. That's the main problem. China has had these discussions that we are having now 10 years ago. They have taken a very heavy-handed state approach to this. Whether it works remains to be seen. But at the moment, Chinese startups have a massive advantage over European or US startups simply because they can build on a large enough customer base. At my program in Cape Town, we have a master's in financial technology. We teach our students hard coding and we send them out to start companies, and they do that. The main challenge they face is getting enough customers. It's not finding funding. It's not even regulatory clarity. Like, we could use more of that, but fine. The main thing is, do you have a large enough platform on which you can test and build your products? And Europe does not have that yet because we don't have the infrastructure for it yet. And I think the challenge is catching up with the countries that have invested in this years ago. So it's nice if we have sandboxes. It does help. It protects you from liability. It's useful, right? For somebody, for starting companies, it's useful. It won't solve the issue. The issue, what will solve the issue is coordinating on infrastructure on which you want to build future services. And which infrastructure this is, it really matters, because we have chosen in the past infrastructure that had unanticipated consequences. I hope that the next iteration of making this choice will draw more from the internet example. There's lots of benefits of how the internet is designed as an open system with clearly defined protocols where you have different actors that can connect to one another. It's not completely unregulated, nor should it be. And there needs to be a clear guideline, clear boundaries from the state saying this is allowed, this is not allowed. The walled garden world of Facebook, where a few private actors monetize large amounts of data, monopolize it, and use it as they see fit, I think this is the main threat, even bigger than the threat of the government overreacting. We have allowed that these companies have amassed a huge advantage over the banks. And I think this will play out in the next couple of years. And the main sort of pessimist to me, the main worry I have is that our banks will not be able to catch up as quickly. Germany has lost 2/3 of our banks since the 1960s. Since 2008, assets under management, employment in the banking sector, profitability has all gone down. At some point, it will become profitable for a company like Amazon or Google or Apple to really move into financial services, as Facebook is doing now. And then every governor should ask their banks, how do you plan to compete with a company that has 2 billion customers and more cash than you have market cap? How do you plan to compete? This is what we need to answer.
That is the subject of another round table, which I hope you will all join. Thank you very much indeed. The vision of a single integrated European digital payments platform is also something we could spend an hour discussing, and is very exciting, so thank you for that. We have overrun, but I note that most people have stayed with us. Thank you very much indeed. I hope you found it worthwhile. I certainly have. I'd like to thank our speakers, Alessandra Perrazzelli from the Banca d'Italia, Peter Kerstens from the EU Commission, Stefan from the German Economic Ministry, and Co-Pierre Georg from a variety of places, but principally Algorand today. I'd like to thank everybody for joining us. Look forward to seeing you, hearing you again. And if you have any compliments, please send them to the speakers, because I think they've done a fabulous job today. And if you have any criticisms, send them to me in ONPIF, and we'll ignore them. Thank you all very, very much indeed. Enjoy the rest of your day, and look forward to speaking to you again soon. Bye.
Thank you very much. Bye.